Okay, let's just dive right into this. Welcome to today's Explainer, where we are tackling a truly fascinating and honestly kind of wild phenomenon that is gripping the financial world right now. I want you to imagine standing by a perfectly tranquil lake. The surface? It's like glass. There's literally not a single ripple in sight. But underneath that serene exterior are these powerful, churning currents that are completely capable of throwing you off course. Well, that is exactly the market environment we are operating in right now. Today, we're going to navigate this incredible divergence between what the market wants you to see on the surface and the hidden turbulence that is churning just below.
52. Now, this isn't just some random statistic to throw around. This is a blaring warning siren for anyone who's actually paying attention. We are currently sitting at 52 consecutive trading days of deep market divergence. And just to put the gravity of that number into perspective, the last time we saw a disconnect this prolonged between market breadth and actual pricing, we were literally staring down the barrel of the year 2000. So to really understand this chaos, we first have to look at what's currently lulling everyday investors into a completely false sense of security.
Section 1. The Illusion of Calm.
If you pop open your brokerage app right now and just take a 10,000-foot view, everything looks perfectly fine, right? You'd think we were in some golden era of stability. The S&P 500 is sitting comfortably up there at 7,443. The Dow Jones, barely down. We're talking a microscopic drop of just 0.59%. So on the surface, the markets are gliding beautifully. But these pristine, top-line numbers are doing a tremendous job of masking some very severe crosscurrents hitting us from geopolitics, tariff threats, and some intense sector volatility.
Section 2. Pressures beneath the surface.
This perfectly illustrates a concept psychologists call duck syndrome. You know the idea. You see a duck gliding effortlessly across a pond, but underneath the waterline, its little webbed feet are just paddling furiously just to stay afloat. Well, the traditional SIBO volatility index, the VIX, is remarkably muted right now at just 17.5. That's actually below its long-term average. It is quite literally a flat line of calm. But underneath the surface, you have the VIX EQ, which measures the volatility for individual stocks. And that is spiking violently over 50. It's paddling furiously. And what this tells us is that while the overall market looks incredibly stable, underneath, your major tech stalwarts and individual equities are experiencing some deep, unpredictable vulnerabilities. So the absolutely crucial question here is, what exactly is driving all this furious paddling? Well, we've got three massive pressure points churning the waters all at the exact same time. First up, on the geopolitical front, escalating U.S.-Iran tensions have brought traffic through the Strait of Hormuz to a virtual standstill. That has pushed Brent crude oil up to $89.22 a barrel, which obviously raises some serious long-term inflation risks. Second, we have trade policy pressures. There's a proposed 50% Section 338 tariff targeting Canadian goods over alleged discriminatory treatment of U.S. exports. And finally, anchoring this whole triangle of pressure is a complete communications blackout from the Federal Reserve. Central bank officials are strictly prohibited from speaking publicly ahead of their crucial policy meeting, so markets are flying completely blind without any guidance right in the middle of earnings season. When you combine inflation risks, trade tariffs, and a silent Fed, that macro pressure eventually bursts into microstorms.
Section 3. Sector Volatility and Contagion.
We are seeing extreme whiplash out there, especially in the semiconductor sector. Initially, the PHLX Semiconductor Index took a brutal 20% slide, straight into bear market territory. That was driven heavily by immediate fears of ebbing AI demand, plus some rapid advances from overseas AI developers. But then, almost immediately, it saw this violent pre-market surge where the index climbed 3% intraday. Why? Because underneath all those short-term fears, there's still a massive, long-term, structural bull case fueled by gigantic data center contracts. It is a complete tug-of-war between short-term vulnerability and long-term capital expenditure buildouts, and it's leading to some massive daily swings.
But hey, this volatility doesn't just stay neatly confined to tech stocks. This timeline of the recent iceberg lettuce scare mops out exactly how quickly panic spreads in today's market. Step 1 was the epicenter. A suspected cyclospora contamination at Taylor Farms triggered a massive FDA recall, only for the FDA to walk it back over the weekend and say, actually, scratch that, it was a false positive test. But the damage was already done. Step 2 was the direct hit to the supply chain. Taco Bell stock closed down 6.1% because they are direct buyers of the suspected produce. But the absolute most fascinating part of this contagion effect happens in Step 3.
Step 3 is sentiment contagion.
Fast casual brands like Sweetgreen, Chipotle, and Kava Group suffered intense market sell-offs purely from consumer avoidance of raw produce. Sweetgreen's stock plummeted 6.1% in absolute lockstep with Taco Bell. And this matters so much because it shows how incredibly fast panic can override fundamental reality in your portfolio. I mean, Sweetgreen had to publicly state that they don't even use iceberg lettuce, yet their stock still took a massive hit. The market just damaged innocent bystanders in the process.
And we are seeing that exact same kind of irrationality when we compare old-guard legacy companies with next-generation hype. Take legacy aviation, represented here by Boeing. Despite securing massive traditional airline orders and sitting on a jaw-dropping 15,000 jet backlog, their stock dropped 2.1%. Why? Because supply chain struggles completely overshadowed everything else. Now compare that to next-gen defense with companies like Archer and Endurel. They revealed an autonomous hybrid electric attack rotorcraft, and Archer's stock absolutely surged 20%, which triggered a massive short squeeze. The market is completely shrugging off guaranteed real-world legacy backlogs in favor of volatile, future-facing defense tech.
And corporate dealmakers, yeah, they're caught right in the middle of this completely unpredictable environment. We're seeing wildly contrasting realities happening at the exact same time. Massive mergers are hitting antitrust brick walls, like that $110 billion Paramount and Warner Bros. Discovery deal, which was just blocked by a federal judge. Yet, literally at the same time, active consolidation is thriving over in Europe, with a $1.3 billion deal creating Europe's largest independent oil and gas producer. Meanwhile, new liquidity events are still somehow pushing forward over here, with Jersey Mike's preparing this really ambitious $1.09 billion IPO. It's just a completely fragmented corporate landscape right now.
Section 4. The Retail Investor Divide.
So if giant multinational corporations are struggling to navigate this, how is the everyday person handling it? Well, retail investors are basically splitting down two completely divergent financial trajectories. Path A is your traditional route, direct indexing. These investors are focusing heavily on S&P 500 foundations. They're holding for the long term and actively stripping out all the hype. They are the slow and steady foundational investors. But then you have Path B, and this is what's being dubbed the degenerate economy. Driven largely by housing unaffordability and this deep desire for 10 to 20x returns, these participants are basically using their smartphones as casino doors. They are flocking to hyper-risky, 0 days to expiration options, literally contracts that expire the very same day they are bought, as well as hype tokens and highly leveraged crypto. They are essentially merging entertainment and gambling with high finance.
And look, whether you personally agree with Path A or Path B, you absolutely cannot deny the cultural resonance of what is happening here. There's this quote I love: America's greatest export is the capital markets. It's no longer just about raising funds for businesses, right? The markets have become a global cultural phenomenon. They're a daily spectator sport. And for those operating in the degenerate economy, it's a high-stakes lottery. This massive divergence in how people fundamentally view and use the stock market adds a huge layer of unpredictability to our entire financial system, which means traditional market logic and might not always protect you.
Section 5, the week ahead.
All right, so with 52 days of deep divergence, geopolitical tensions flaring up, and a completely fractured investor base, what actually happens next? What are the upcoming catalysts that could either finally calm this underlying chaos or just break the surface tension completely? Well, we are staring down a packed and highly volatile catalyst calendar over the next few days. On Tuesday, we get an early look at auto demand and Q2 earnings with General Motors. Wednesday brings Tesla, which is going to give us a really vital read on EV demand and margins. Thursday is just a massive macro day. We get jobless claims to test the health of the economy, and that collides right into Intel's earnings, which will thoroughly test that chip stock rebound we talked about earlier. Then Friday drops the preliminary July S&P Global PMI, which is a crucial health check on manufacturing and services, alongside the new home sales figures. And remember, all of these dominoes are going to fall just days before that looming July 28th and 29th Federal Reserve policy meeting.
So the surface of the market looks perfectly pristine, but the crosscurrents underneath are truly historic right now. Which brings us to the most important takeaway for you as you sit down to review your own portfolio and strategy in the face of this unprecedented 52-day divergence. You have to ask yourself, are you simply gliding on the surface, trusting those top-line numbers, or are you actively prepared for what's paddling furiously in the dark beneath? Thank you so much for joining me on this explainer. I really hope this helps you navigate all the turbulence ahead. Keep learning, stay focused, and I will see you next time.